Welcome to this class. In the world of multinational corporations and finances, we're going to talk about a web working together to make simplicity and get things going with different approaches. I'm going to turn it over to Jim and his team who is going to talk about it. Again, we've talked about the CPE. You're going to get one course credit for that, and it's going to go over the same exact stuff. So I'm going to turn it over to them. They're going to talk about you. I don't want to waste any more time because we're already getting cut short 10 minutes. If y'all have any questions after this class, you can refer them to the knowledge bar or to them. I'm going to be monitoring Slido. There's another way to submit questions and answers, and we will pass it on to them.
Thanks.
Okay, everyone, welcome to Simplifying Your Intercompany Settlement Process. I'm going to go over the agenda real quick, and then we'll hop into speaker introductions, which is going to be first. So after speaker introductions, we're going to talk about Corpay Cross-Border, who we are and what we do. And then we're going to talk about bandwidth, which is the company Scott works for. And then we're going to talk about what is intercompany netting. And then after that, what does the intercompany settlement process look like? And then we'll take a deep dive into some of the customer benefits of incorporating intercompany netting. And then we'll have a panel discussion and questions around this. So myself, I'm Jim Kessler. I'm the VP of Global Treasury Solutions here at Corpay. I come from a corporate treasury background. I have 20 plus years experience working for large multinational companies in a global treasury capacity. A lot of that is around foreign exchange risk management and intercompany netting.
Yeah, I'm Scott Taylor. I'm the treasurer of Bandwidth Inc. Like Jim, I also have over 20 years of corporate treasury and consulting experience, which makes us old, I think, Jim.
Yeah.
I mean, I told a story at work recently, and somebody young said, the year I started working in treasury, she said, "Oh, that's when I was born."
I was like, hey. Thanks for that depressing note, Scott. All right, so I know Rick covered this in his presentation this morning about Corpay Cross-Border and who we are, but I'll point out a few highlights. We are the world's largest non-bank foreign exchange provider. So what that means is we operate like a bank, but we operate a lot faster and leaner. Another point is we have 23 offices in 11 countries, and we're headquartered in Toronto, Canada. Of course, our parent company is Corpay out of Atlanta, Georgia. And I will pass it over to Scott to discuss what Bandwidth looks like.
Yeah, so Bandwidth is, we're headquartered in Raleigh, North Carolina. Bandwidth is a global communications, cloud communication provider. So our technology helps embed voice, messaging, emergency services into apps, into call centers, into the enterprise. So we have our network, our cloud network is in over 65 countries, covers 90% of global GDP. Some of our customers, as you see on the screen, Microsoft, Amazon, Zoom. So you have all interacted with Bandwidth technology. It might be when you swipe your card at a local coffee shop, that text receipt that you get, that's from Bandwidth. It could be your pharmacy letting you know that your prescription's available. When you call into a call center, the dispute on your credit card, that may very well be on Bandwidth's network.
Excellent. Thanks, Scott. So the topic at hand, what is intercompany netting, right? So I think a picture paints 1,000 words, right? So without multilateral netting, you have all these payments going back and forth between intercompany subsidiaries, different currencies, different amounts, going all across the globe. What intercompany netting does, it takes all that mess and gives it a nice, pretty picture for one payment for each sub in a local currency into the netting center. So I'm going to provide you with an example of where I used to work at. Most of you guys are familiar with Bobcat construction equipment. You've seen them at every construction site. So we had manufacturing facilities in Mexico and Czech Republic and a few other places. And then we had sales offices all around the globe. So when a customer ordered a machine, they would either order it from Mexico or the Czech Republic, and they would have to make a payment to that entity in that currency. So imagine that going on 10,000 times a month, right? So it became a disaster. It was difficult to manage, and we introduced netting and made the process much easier and much less hectic, but also saved us a lot of money and time. And I think Scott can probably attest to that as well.
Yeah, so that the picture it shows you it's jumbled. It doesn't look better on a spreadsheet. So when you lay those out, when you lay those bilateral and you put it on a spreadsheet, so similar to Jim, my previous company was CommScope, also a global manufacturer We did not have multilateral netting, so it was bilateral. So we had two people in Treasury that were dedicated to settling that process. And it took a little over a week every month. They would go through, there was a big workbook with 80 tabs, and they used to joke about having the decoder ring to decipher what exactly was going on. So there is a better way we're going to talk about.
All right, we're going to take a deep dive into some of the common benefits of netting. So as I mentioned before in both our examples, there's a reduction in banking transfer costs, right? So you're eliminating a lot of unnecessary wires and a lot of unnecessary foreign exchange conversion costs. Also reduction in hedging costs, right? If you have something settling, you don't necessarily need to hedge it, so it reduces that cost of hedging. Really important to most treasurers like Scott is centralization of information and skill sets, right? So you're taking all this information that's all around the globe and you're putting it into one specific place, which provides you much greater visibility into what's going on in the movements of the money. Which brings my next point, it brings more structure and discipline to intercompany payments. So entity A, no one is receiving money from entity B, so they can help with their cash forecasting and things like this. So it creates more transparency around when you're going to receive cash and when things are happening, as opposed to it just coming in sporadically and you have no idea what it is. So on that note, it also provides forecasting accuracy. If you see the money coming in, you can actually forecast for it and understand that helps you manage the cash. And I know, Scott, you had a lot of benefits around cash management and how the netting kind of solved some of those issues for you.
Yeah, so there's a couple things. For us, when this really got dropped on us at Bandwidth, our tax team had done a lot of work, created transfer pricing, cost plus model. In the first time, so we knew that was coming, but I didn't know what it was going to look like. I thought it would be relatively simple. The first time that file was delivered to us, and it was like, hey, you need to go settle this. It was 200 cross-border, cross-currency transactions across 30 subsidiaries, entities. So it took us almost 3 weeks the first time we went through it. Just trying to match up, like I said, taking that spreadsheet and just going, this entity can pay this one, and then this one. It was like piecing together a puzzle. It was, it's timely. The first time we went through it, it took us so long that one of the larger trades, the rates had moved so much that we didn't actually settle the final trade because it was going to create such a large loss. So yeah, it was not a fun experience the first few rounds for us.
You want to discuss some of the benefits that it kind of brought you guys? You kind of painted the picture before, so kind of after you kind of guys incorporated netting, what did that look like from a time saving perspective as well as a cost perspective? Yeah,
so we got a little bit better. We had cut that down to like a 2-week process. Still very painful. We're not a big company. We're pretty lean. Only 3 people in treasury, 2 people with me. So that time that it was taken, we couldn't do that. We just could not get by doing that. As when we started doing multilateral netting with Corpay, that turned into like basically a 2-day process to get everything run, to run that file, get the results, get the funding, make the trades. So it's, just in the time that it saves us, which is not time we have. I've got a lot, a lot of responsibilities. So just in that time, but it shortens that time period that rates can move. So those FX gains or losses shouldn't be as dramatic. We also, for the first time in my treasury career over the last few years, we actually have rates. We actually have rates that never really been above 2.5%. in the U.S. Or anywhere. They were negative in Europe and other parts of the world. We actually have rate. We have interest. We want that money invested. So if you're sitting for 2 weeks and you have things in kind of holding in a hold pattern, it really costs something now. And if you're borrowing, fortunately we're not. But if you have borrowing costs, that's even greater. It's a greater cost than it is and the interest income to us.
Yeah, I've seen that in the past as well. Trying to get those pockets of cash invested, right, and trying to get in the right places. And netting can do that. You run a netting cycle, it brings all those pockets of cash together and provides visibility, as I mentioned before. So we're going to roll on to intercompany netting considerations. So there's a few considerations to take into consideration once you are looking at an intercompany netting. So payables or receivables, right? So a lot of people go back and forth on this, which one's the best, payables or receivables. In my experience, and a lot of people will agree with me, payables is much better than receivables. Why? Because payables, if people enter a payable into the system, that means they have the intent of making that payment, right? If you enter a receivable into the system, to me, that's just a wish list. You're hoping to get that receivable. You don't know if the other entity has the intention of making that payable to you. So with that, most people tend to go with the payable method, although some larger companies may use the receivable method. Selecting a netting base currency. So this is basically the currency to which everything nets back to. If you're in the US, usually you would use US dollars as your base currency. Unless you have a tax center or something like that over in Europe, you may use euro. Depends on your situation. You have to consult with your tax team to make sure you're picking the correct base currency to settle in. I know, Scott, you guys settle in USD. Was there any considerations in regards to tax as to why that was?
Yeah, for us, it was pretty simple. 80% of our revenue is in USD. A lot of our expenses are. So it made sense for us to be in USD. It was also really simple, like Jim said, to use payables. So we create invoices in the ERP, whether it's just, transfer pricing invoices or intercompany balances that it's easy to generate invoices. And then those, as we'll talk about a little bit later, when we go through the settlement process, marking those invoices as paid in our system in an automated way by just uploading a file, an output file, that was also a big benefit for us.
Okay. Next, who can participate? This is always a question I get a lot. A lot of countries cannot participate in netting. It's usual suspects: China, India, Brazil. Basically anywhere in South America with the exception of Mexico, which is actually North America, but those countries. So there's a lot of considerations there. You can't really include those countries. I know, Scott, you guys have a few countries that you don't include. So how do you guys handle that process with the regular netting participants as well as the ones that cannot participate?
Yeah, so even though we aren't settling those all at once, we have a few. We have 3 countries that we kind of exclude from the process. But then we were able to still do the netting cycle to get the settlements, and then we just, after our 2-day kind of process, we go back and settle those kind of manually as more of a one-off. But we still can net those down to a single transaction instead of having to clear off like numerous invoices.
So the countries that can, that takes a lot of the heavy lifting off of the whole process.
That's right.
The vast majority of it.
Yeah. And I'll say, like, if even on the base currency, it would be easy that'd be an easy flip for you because I think we're probably getting into a situation where we might have some other use cases, and I think that's a pretty easy flip for
most of the systems that I've seen and that I'm familiar with. You can flip the base currency rather quickly, right? It's like you said, just flipping a switch, and a lot of times that can change for companies as they grow. If they have an acquisition, those needs may change. So they may need to flip the base currency. And that, like I said, that always comes from usually the direction of the tax team that kind of dictates what that is. Adding third parties. So we use this term intercompany netting, right? Intercompany just kind of stuck, but people actually use it to pay third-party payables. So if you have a large vendor and their payment cycles line up with your netting cycle, you can actually include that vendor as a participant. And we have in the past, right? At Bobcat, we used to have some huge vendors. We would include those folks in that cycle to help eliminate some of the unnecessary effects. So it was actually quite helpful for all of us to have, for our team, our accounts payable team, to put those in the netting and include those all at one time. They got the benefits of the visibility, and also from a cash perspective, it helped out quite a bit.
Yeah, so I just recently it's come to my attention that we have several customers that are also vendors. So we have these like revenue share kind of netting, and with someone, kind of, we haven't had layoffs, but we have let attrition take its course to some extent. So we have a few less people doing more work, like a lot of places. And as that has come over, we've recognized that it's a real challenge, that we do have these relationships. So we're gonna start looking at that one, and I think this would fit in well to help us, simplify that process.
Yeah, that's a good point. I've had situations in the past of places I've worked before. We used the netting tool to pay third parties. So we had a bunch of third party payment runs in different currencies. We would just put it into the netting tool, let it net out, and then just fund it with FX trades. So instead of making 1,000 individual currency payments, we would net it out into one payment to the bank and then have them deliver to all the beneficiaries. So it made that much easier. The last on this list is the netting frequency, and this kind of depends on the company, but the rule of thumb is most companies tend to settle on a monthly basis, right? That's the most common. We have some clients in companies that I've seen that do it on a quarterly basis, some annually, but that's not really very common. But like I said, the rule of thumb is monthly. And Scott, you guys are usually settling on a quarterly basis, but that's probably going to change as you guys evolve.
Yeah, so we have been doing quarterly, but we have a number of different things going on that is, probably going to change the frequency of how we do it. The good thing is we had, and, talking about like setting those dates, we just had recently, we had a kind of a cadence, and tax team came to us and were like, hey, could you settle like before the quarter ends? And how difficult is that for you? And I was like, actually not that difficult at all. I just sent a file over to Jim and
So before, would that have been possible before, if they say, hey, we need to settle this within a week?
Absolutely not. Okay. There's no chance. Yeah, there's just no chance, because the time it was taking us to kind of piece everything together, it really was like a puzzle. I mean, it really was like, this entity pays this one, and then this one has enough to pay this one, and it's tough.
It's very common. Having worked in corporate treasury, and you can attest to this, most of the Treasury Department runs on an Excel spreadsheet, right? That's how it operates. And usually there's 87 tabs at the bottom of each sheet. They're tied to another sheet, and it's a nightmare. So those of you in corporate treasury can certainly understand what I'm talking about. See a few heads nodding. All right. The next we have is a netting calendar. So like I said, most companies do this on a monthly basis. However, it can be quarterly. But there's 3 key dates here that we have. The first one is the input cutoff date. So this is the date where everybody's entering all their payables into the system, right? At some point, we got to stop that, right? Stop it and perform our calculations, which most netting systems do. So the next is the netting date, and that's the date where we say, okay, everything's in the system. Let's calculate what the trades are to fund this netting center and actually perform those trades. And then usually a day or two later is the settlement date. This is the value date of the foreign exchange funding trades that you do, as well as the same date that the subsidiaries that are participating in netting will either deliver into the netting center or receive into the netting center. So I know, Scott, you guys have a lot of different subs. For example, they're all euro functional. Some of those entities are receiving euros, and some of those are paying euros. But the trade that you guys do to make those payments is the net of all those euro functional subsidiaries.
Yeah, so we had been, like I said, our cadence had been that we were closing the quarter. So we were getting to around, it was sometime like this, around the 20th. We were getting to close the quarter, make sure that all transactions, all the intercompany balances are accurate before we go in. And we were doing it in a few days. Every time we've tightened it up a little bit. And I think, as we go through this, I think our goal is going to be the day it's closed, we're going to run that report. We're going to run it the next day and then begin settlement the same day. Because we can, I think, having less time for the rates to move, because we all see that they've been more volatile in the last few years than also in my life. So even a simple, Euro USD can move quite a bit over a couple of days. So we're trying to tighten all that up, and we can. That's the great thing, is that we actually have the ability to do it very fast.
I can imagine it was probably troublesome when you had 3 weeks in between to do the process.
Oh, it really
the rates can move quite a bit in 3 weeks, as we all know.
Yeah, right? Yeah. The first time, I said it earlier, but we ended up with a trade that we were like running through it, and when we saw what the loss was going to be, CFO said, no. You can't do that, right? You can't do that at the end of the quarter and take that. You can't put that kind of loss on us at the end of the quarter. So it was like, wait till the rate's better. It's like, rate might not ever get better.
Okay, we talked about kind of what the process is. Now we'll kind of take a deep dive into mechanics and how this works. So as you can see here, usually as I mentioned, you have a netting center and you have subsidiaries that upload their information into the netting system. So everybody is entering their payables into the system. What happens next, the system actually takes those and nets everything out and gives each entity one payable or receivable with their local currency based on their activity. The next is you have the settlement of all those, which is the date that I showed you before, the settlement date where everyone either pays into the netting center or receives money from the netting center. And then lastly, once they have that report and the money's been paid, they have to go in and perform a reconciliation and book those entries in the ERP system. So I know, Scott, you guys had some trouble actually getting the data into your ERP system, and that was kind of difficult for you. So trying to explain to them, if you have an entity with 500 different payables or receivables, and they have one net number that reconciles down. So how do you guys go about reconciling all those individual invoices to the one payment that's either incoming or outgoing?
Yeah, it's that extract file once we've loaded all those balances, Corpay actually did the work to format to fit so that what was coming out of ERP, if we get a file that's formatted the same way, we're able to upload that to eliminate. Because one thing that I haven't mentioned yet, is that when we got through that 2 or 3 week process, we got everything settled, and then we had, for us, it was about 200. It was like close to 200 individual transactions that were having to be made. But then that also created 200 manual journal entries that had to be made by my team. So now when we upload that, because we're using payables and we have invoices, when we upload that file into our ERP, which is NetSuite, it's marking all those as paid, and the entry's done, everything's made, it's clean.
Yeah, and that was a relatively easy file mapping exercise, right? It was basically taking the output and just mapping that to the parameters of Oracle NetSuite.
Yeah.
So most netting systems out there are pretty, able to maneuver pretty quickly on those type of things. So jumping in, we'll take a deeper dive into the customer benefits. I know we mentioned these briefly at the beginning of the presentation, but we're going to take a deeper dive into them now. And then we could talk about some of our experiences into those benefits and how those have impacted us. So one is efficient cash management, right? And this is huge, right? So as I mentioned before, it gives you cash visibility as to where cash is going to be. And you're able to take those balances and deploy it to where it needs to be, right? So if you have an entity that needs cash, you can take that from the netting and deploy it over here. So it gives you a bigger picture of where your cash pockets are going to end up and being able to deploy that effectively. Secondly, saving costs, right? This is really big. A lot of systems out there have a calculator, but what it does is consolidates transactions, right? It eliminates unnecessary FX. So if you have all these payables coming back, these FX going back and forth, what the netting center does, it basically takes it, puts it together, it offsets all the netting. So we have some clients that I've seen in the past go from 50 million in FX notional down to 15 million in notional just by running a netting cycle. So they're eliminating a lot of the unnecessary FX. Secondly, another big one is the elimination of wires, right? So before, that picture I showed you before had all those wires going back and forth individually. You may have 3,000-4,000 wires a month. With a netting center, it reduces it down to 15 or 20, depending on the number of subsidiaries you have in the netting. So not only is that saving money per wire fee, imagine the man hours it's saving of your accounting team or your AP team creating those wires. So it makes it much easier. And Scott, you guys kind of have seen that impact directly on your team.
Yeah, so we went from it was about 200. We were making it was about 200 transactions, or nearly 200. So 200, and almost every one of them was a wire. When this was first coming up for us, one thing I didn't mention is a very well-meaning our director of accounting brought up the idea that because we were generating invoices, that Treasury, like, I don't even think we need you guys. We'll just run it. We'll just let AP process these. And we were in a meeting with tax, and I was kind of like, okay, well, let's take a look at it. Yeah, we'll take a look at that. We'll see how, when I looked at it, only like 20 of the 200 were same currency. So there were a few that could have been like SEPA transactions. And when I had to lay this out and show them like how much, if we were just running this through our bank, it would have cost us like $1 million a month or a settlement because those were going to be the worst rates we were going to see. And I had, so there was some education internally of why we couldn't just let AP process it like they're any other transaction. So then I've talked about too that cash, the cash. We earn over 5% on our cash overnight. So first time in my life that's happened. So it's meaningful. But then for the notional, we were trading about $90 million. It was about 90 million notional that was trading, and we've reduced that to less than 15. So it's a big deal. It's a really big deal.
Yes, the last 2 points on there, we briefly touched on is streamlining processes, right? And you mentioned before you had the accountants doing all the wires and the reconciliation, so it created a lot of lifted a lot of the burden from the back end, right?
Yep.
Of that process, and I've seen that in my experience too. It frees up the accountants and for different duties besides just doing journal entries manually.
Yeah, the one thing we haven't mentioned, and when you're doing 200 manual transactions like that and you're not doing them all at once, you're trying to, the time we were spending just piecing together, because for us, like there were really 3 or 4 phases that we had to do, because like I said, I've said this entity has enough to pay this one, and then I can't immediately go back to this one. I also need this entity to pay A, so that A then has enough to settle out to C. The time it would take to sit there and go through that is painful. I mean, it's a really awful process. And then that's not just for us, but then errors are made. So in that first cycle, not only did it take us almost 3 weeks, but we sent too much. We doubled one payment to one entity. Several of the journal entries got backwards. So we were going back and reworking all of that. The accounting staff, the person who is like kind of responsible for intercompany balances, is taking more time to kind of reconcile all the things that we were doing. It's been extremely clean. She loves it. Because now she runs the report for us. We get the report when everything's settled. It's uploaded. It's done. The reconciliation's super clean now.
Yeah, and lastly, before we hop into bandwidth, kind of in the details, enhanced financial visibility, right? I mentioned that before a couple times, right? You're able to see where the cash pockets are, be able to deploy that effectively. So now we're going to jump over to bandwidth, and Scott's going to kind of walk us through the bandwidth and kind of the realization of why they needed netting, when they implemented netting, and kind of the results. So from A to Z, walk us through the whole thought process, the issues they were having, and how this resolved a lot of their issues.
Yeah, so we, as you can see, we're, like I mentioned earlier, we're in 65 countries. We have, it's 30 subsidiaries in total. When we first acquired, Bandwidth acquired a company called Voxbone out of Belgium. When we did that, before the transfer pricing cost plus model was in place, we did these intercompany transactions, and there were like 12 transactions. It was pretty simple. It wasn't that complex. But once that was introduced, once the transfer pricing, and as time has kind of gone on, a number of other things that just happen in the business that create these intercompany balances, intercompany transactions, kind of started to bubble up for us. And like the first time after that was introduced, it went from being, a dozen transactions to 200.
I think we're a slide ahead. You kind of went to the first bullet point there.
Yeah. So we've talked about some of these things. It really was for us. We did that first time, and I thought maybe there was like some optimism that this was the first time. Maybe it's not that bad. Maybe when we go through it the next time. For one, I wasn't expecting that many transactions. We only had 30. We had 30 entities, and we're not a manufacturing company. The second time it came around to us, it was the same thing. There were also errors made in the transfer pricing. So we were, getting hit with amounts that, sometimes didn't make sense. And then trying to settle all those things when, again, even the large entity didn't have enough to cover the payments to, in sub A or sub B. So it was a tough process.
Yeah, I think you saw a lot of reduction in FX conversion costs, right? And you guys don't have that many transactions running through. In my experience, I've seen companies with 10,000 transactions, right? And more than the 200 that you guys have. So the wire savings on that alone is huge, but also the savings in terms of internal resources, right? And deploying those, and instead of having a whole team doing these manually, intercompany netting resolves that, right? It gives them one payment for all these invoices. So instead of 10,000 wire settlements, you're down to 10 or 15. So next we'll kind of talk about your guys' journey, right? And kind of how you guys came to the realization. I know we kind of worked with you on this, but you're trying to reduce your FX costs and conversion fees. And as you mentioned, you saw the realization. So what happened after that, after you guys realized that you needed this? What was the next step in that journey?
Yeah, so it was unworkable for us. I mentioned that we're a small team of 3. It was not something that we could keep doing. We're lean. We have a lot going on. Just could not do it. Started thinking about. I knew from working with Jim in the past. I knew that the multilateral netting. I had experience with running through a bilateral netting, and that wasn't going to create that much benefit for us. So we started talking. We ran through. I mentioned the formatting of the file because that was important to us to eliminate the journal entries. It was, one thing to eliminate all the FX cost. Help us with the cash management, kind of getting us to settlement quicker so that we could keep our cash invested as much as possible. I'm tight. I'm really tight with it. So, I try to run balances in all the accounts. If there's an investment option, I'm putting it all in there like every night. I don't like to lose any dollars. So having that, being able to do that, being able to settle that was so important to us, but really it was absolutely unworkable. So when we started working, we did the, one of the times we were kind of going through our whole process, the way we were going through it in several weeks, Jim took that file, ran it through for us. We saw what it would look like, and we made the decision that we were going. One of Bandwidth's thing is be bold, so there wasn't any fear of no fear of failure. So we went for it, and it's worked out great for us.
It seems like you guys are on an ongoing basis. Now, I think in my experience, working with subs around the globe, you get a lot of pushback, or they don't want to change their processes, right? And I've experienced them saying, no, we don't want to do this. It's going to create work for us. And they kind of work in this bubble. They don't understand the larger benefit, right? So did you guys experience any of that?
The accounting team was nervous. They were a little bit nervous about it. We had to show, so that's why we went through kind of the mock. We went through it one time where we did it. We were going through the process we were going through, but then we're able to show them the report, like, hey, instead of making 200, like for us, we end up, most times we have 2 entities that pay in. We have 2 payers. Everybody else is a net receiver. So we're like, hey, we're going to make 2 large wires into the netting center, and then we're actually not even making all the wires. Then it becomes Corpay just settling out the foreign currency transactions. It's super simple for us, but it also, they got comfort in seeing that file. So we got that formatted in a way that we ran it into the sandbox a few times. It all worked. Very few tweaks needed. So it was really simple for us. And I'll add, we didn't need our NetSuite team, and that's a big deal. That's a really, like everybody's, you can't necessarily easily get IT resources. So any type of solution, I'm definitely interested when I hear about or know about a solution that doesn't take IT being involved. They had to go through, they wanted to do like security and all that, but we weren't actually connecting. So it was so simple for us. So, a lot of the work was Corpay doing the work, but for us, it was really light. No IT touch at all, actually.
Excellent. And so you guys are, as we mentioned before, ongoing on a quarterly basis, but the intention of going monthly as soon as you guys see some more activity. So I think we've kind of went. Sorry to cut you off. Go ahead.
Yeah. So one thing we're a growing company. As we've as being a global company, something that we've just very recently introduced is universal billing. So we invoice out of the U.S. We also invoice out of Europe. We're finally to the point that we're consolidating that process. And what happens, it's great for our customers, but we have now customers who, are in the U.S. and are buying European, services in Europe, and they may want to be invoiced in dollars. We have the opposite of that, where a customer now wants to be invoiced in euros. So we are getting to this. We're starting to see it happen that somebody's invoiced by our European entity. They're paying everything into Bandwidth Inc. And then we have the opposite of that happening. The cash applications, the AR collections team also report to me. So currently, we have not solved this one yet, but it's becoming more and more of an issue as we have customers paying in. And when that happens, instead of just simply applying the cash to where it is, they're having to stop what they're doing and say, this much of this amount we received needs to go back to the other entity. So we're stopping and making these manual transactions. So that's something that we're gonna, it's not just gonna be this transfer of pricing, but we're gonna probably go to a monthly to resolve this customer collections thing that we have going on now.
Yeah, I see a lot of companies get in with the intention of intercompany, and they kind of see different uses for netting, right? So invoice settlement, you guys use it for transfer pricing. There's dozen different ways to use it.
And now we're seeing this because there are people in the organization that want to be able to offer our customers to pay us in any currency they want to pay us in. I don't love that, but I know that we have a way to solve for it if we get to that point where it becomes large dollar amounts.
Fantastic. So the next slide we have is for continuing education. So for those who are signed up for the CPE credits, I will give you a few seconds, actually a minute or two, to complete these questions. You guys, all you have to do is just scan the QR code, and these should pop up.
Yeah, 12 in the room.
12 in the rooms? Okay, I see one in there right now, so I'll give it a few more minutes until we see that. All right. After that awkward pause, I think one more over there. Okay. Yeah. All right. So the answer to that question is consolidate and offset. So those of you who missed it, go back and change your answer real quick. I won't tell. Uh-oh. There's the quiz. Second question. Which of the options below is not common benefit of intercompany netting? See, 0 people on there. 1, okay. All right, so I think most of you guys see a few still typing. I'll give another couple seconds. Unless you guys are texting someone. All right, so those have just joined. You're going to get the luxury of seeing the answer. There you go. So won't eliminate accounting for intercompany transactions. That's always going to exist, right? So any transaction you have in your system has to be accounted for. So it doesn't eliminate that transaction,
but it does simplify it.
It does simplify it. It does not eliminate it. It's a trick question. I'll go back. Ready?
All right.
Okay.
Like people are arguing with each other.
I know. I see a lot of answers changing real time. All right. True or false? Every country can participate in intercompany netting.
I can't quit.
Yeah, I think this better be.
Think Argentina.
This better be all green.
Think Argentina.
Oh, nailed it. Fantastic. People are paying attention. All right. So now we go on to the panel discussion questions. So we have a few up here. And Scott and I have kind of covered them ad nauseum, right? So I want to reach out to the audience to see if there are any individual questions around netting or our experience around netting and help it resolve some of our issues from a corporate treasury perspective. Sure.
I just had my first question was about what sort of is the minimum size of the company volume, whether it's transaction in dollars that you in the company that what?
That's a great question, right? And the answer is it depends, right? So usually what we do, in my experience, we work with clients and say, we don't know until we know what the information is. Let's take the data, run it through the system to see what kind of activity there is, and then we can determine if it makes sense or not, what the volumes are. And in our system, in the Corpay system, we have a tool that actually calculates the savings for you. So you have this many wires, reduce it down to this. This is your FX volume before. This is your FX volume after. Here's your savings based on those figures. So the rule of thumb is, if you're saving $50,000 a month, it's worth it, right, to do it. But like I said, the benefits are not only quantifiable, but from a resource perspective is where you see a lot of it. And Scott, you can see a lot.
So we had, before I mentioned that when we first acquired the entity in Belgium, we had the first few times it was just a few intercompany balances. We had like 12 transactions the first couple of times. It was pretty simple. For us, it was, once tax introduced the cost plus, I say it was simple, but we also had funding issues though. So before that was introduced, we were really making more than that. It just was, those were ad hoc. Those were like, we need money in Turkey. We need money in so-and-so. So once they introduced that, it became something that was like, we can't do this every time we go around. But at first, the dozen transactions was pretty easy. The calculator's always going in my head of like, it's costing us forever to buy euros. Didn't know we were going to have to do this. It wasn't ever forecasted. I asked that question of tax a bunch of times, like, can you forecast this for us? Can you give us some idea?
I think your other point as well is what that money could be doing instead is important, even relative to size. I look at, we have a group of companies in multiple countries, and we don't have to worry about whether they need money or not because they hold on to a lot. Well, that's costing us money.
Right.
Holding on to funds, they're not invested, they're not earning, because we don't want to have to be constantly paying attention to it. Well, that's not necessarily the right approach.
Yeah. And for us, we also had some that, there were some intercompany transactions that were just being left, that were just kind of left outstanding. And then you run into other problems. Then you run in, that becomes a short-term loan. And then it becomes taxable income, so there's a lot if you don't have a process for how you're going to settle these, types of intercompany transactions timely and efficiently, there are other problems come up and cost. Yeah,
it's a good point on the payables. They're sitting too long.
It has to.
Tax will come knock on your door and say, this is an intercompany loan.
Yeah.
We got to treat it as such, right?
Yeah,
So,
and then you have to, then you're writing up different, then you got to go get legal involved to write a contract and start charging interest, and that's another spreadsheet we're maintaining. We had a few of those. We eliminated all those intercompany loans in the process too. I didn't mention that earlier.
Just a question for
Sure.
everyone. When you're recording, are you recording them in your US dollars or are you recording them in euros? Are you translating everything to one currency at that point? And then are you evaluating your divisions on US dollar? And then are they complaining about the exchange rate that you're using or feeding back to them because you've netted everything along the way? All I'm getting is that we have intra-trader, not inter-traders, or inter-companies, as it were, and somebody want to buy and sell the currency, and they're diametrically opposed animals. So when we came and corporately said you're going under one rate, it's a pacifying situation. But how do you find that, or how do you deal with that netting and performance reporting?
It's a great question. So in our experience, how our netting set up, each entity receives a payment or receipt in their local currency, right? So that is what they're receiving. They're not transacting FX back and forth. They receive one payment in their local currency. So that eliminates the first part of your question, that issue. The second part is when they have all these different invoices in different currencies, those have to be remeasured as they're settled every month, right? And that's usually between whatever the book rate is and the actual transaction rate that's run through the netting. So you'll have the book rate versus the netting rate, and there's a small difference between those two. Whatever that is booked to realized foreign exchange gain or loss. So there's kind of two separate components to that question. Does that answer? Okay. Anybody else? Brendan?
Yeah, I had one question on the putting third parties into the netting cycle. So you were saying that you had one large vendor that all of the subs were dealing with, or something like that? Mm. How does it work? Are all of those subs making a payment to that vendor, and therefore you're just aggregating that amount and doing one trade?
Correct. So we would send that vendor up as a entity in the system, right? An entity. All they were doing is receiving, right? So everybody's entering payables, which produces a receivable for that vendor. So what it does, it takes all those individual transactions and it gives one net payment to the vendor in that currency. So and then we'd send that file over to the vendor and say, hey, here's this payment, here's the file that goes with it, here's how you reconcile what this whole amount's for, and here's the breakdown of that.
The use case that I think we're about to start with is we'll just run that as an entirely separate cycle of the customer vendor relationships. We'll just run those in a separate.
Mark?
It's just sort of thinking in my head, one of the other arguments for including a third-party organization into the netting cycle is that there are two-way payments to them. So if they're a customer and they're a partner or whatever the case might be, it's a way of reducing the counterparty credit risk associated with that third-party entity as well. So rather than the large notionals going back and forth, the risk that we're paying them
right.
and they're not paying us, just doing one netted settlement at the end of the period reduces that exposure that you're paying them and not receiving value back.
Absolutely,
yeah,
and
that's right.
The logic's already incorporated in the system for magnitude of types of settlements. So any kind of netting logic, the system can perform that, right? So between two entities, whether they're internal, external, whatever the case may be, it can resolve those. Any further questions? I know we're coming up on eclipse time, and I don't want to cut into
a few minutes.
No. Yeah. Before we break here, one last reminder: everyone, make sure you bring your badge to Chiefs tonight for the after party. If you don't have this, they will not let you in the venue. So make sure you have this when you go tonight.
That's the most important thing, Jim.
That is the key takeaway. Yeah. Exactly. No chairs off balconies or bar glasses.
No passes off balconies.
Yes, no passes off balconies. Anything like that. Thanks, everyone. Appreciate it.
Yeah, thank you.